joining another RavenPack Chat with the Experts webinar, where we will be discussing ESG investing in the APAC region. To discuss this interesting topic, I'm joined by Bei, PhD and Research Fellow at Monash University in Australia, and Mixo, Asia Equity and Quant Strategist at JP Morgan Chase, based in Hong Kong. First of all, thank you both for joining me today. I would like to get, it would be great if you could introduce yourself to the audience. Perhaps Bei, you could kick it off.
Yeah, sure. Thanks, Peter. First of all, I want to thank you, Peter, and RavenPack for hosting me and hosting this webinar. And, thanks for everybody who listened to this webinar. I'm Bei. I'm a research fellow of Monash Center for Financial Study at Monash University. I mainly do, industry-relevant academic research in the area of market microstructure, the market efficiency, and sustainable investments. Yeah, that's all for me, Peter.
Perfect. Thank you, Mixo.
Great. Yeah. So hi everyone, and thanks Peter and RavenPack team for this opportunity. I hope we'll have a good, productive discussion on how we look at ESG. So if you look at JP Morgan's research overall, I would say that there's been an exponential growth in the amount of work that we've done around ESG. So both from a strategy perspective, from a quant perspective, so trying to fit in, connect all the dots in terms of how exactly ESG affects market prices and how investors look at that and how investors make money out of that. So all those things, and there's been a tremendous amount of growth in that space. And obviously, as you know, among the investor community, we've seen a very, very large growth in the ESG AUM. I don't want to say specific numbers here because it really depends on how you measure it. And in some sense, if you say that, pretty much every active manager is an ESG manager, because everyone cares about governance, right? So again, I'm Mixo. I cover equity and quant strategy for Asia at JP Morgan, and look forward to this discussion.
Perfect. That sounds good. Thank you very much again for joining. My name is Peter Hafez. I'm the Chief Data Scientist here at RavenPack, where I've had the pleasure of working for more than 12 years, working with investors on how to take advantage of NLP-driven sentiment and event data across multi-asset class investment processes. But before we kick it off, I'd like to draw your attention to the right-hand side of the screen. You'll see we have some resources available to download, being a few research papers from RavenPack and Monash University. I suggest that you download these before the end of the webinar while they're still available. In addition, I'd like to open up the floor for questions from the audience throughout the webinar. Please type in any questions that you might have into the questions box, and we'll try to answer them as they come in. If we don't get around to answering your question, we'll try to answer them directly after the webinar via email. With that said, before I hand it over to our two guest speakers, I would like to spend the next 8 to 10 minutes to introduce our topic and to provide an overview of how RavenPack thinks about sustainable investing. Each speaker will then present for about 10 minutes, followed by a broader discussion on the topic. The increase in interest around sustainable or ESG investing has been very obvious in recent years, not only when we speak to clients who seem more interested in getting ESG insights than engaging in alpha discussions, but also when reading the news. It almost feels like that every single news article has some ESG or climate change angle to it. And clearly the investment community is taking notice. Using the RavenPack search engine, we decided to track the number of times ESG investing was mentioned in the news, and focusing on the annual growth rate, we have seen a staggering 100% increase over the last couple of years. The media focus is also clearly being reflected in the number of new exchange-traded funds that have been launched over the years, as well as the total AUM that are currently being managed. According to recent MSCI survey, almost 80% of investors across the APAC region increased ESG investments significantly or moderately in response to COVID-19. Furthermore, close to 60% of APAC investors expect to have completely or to a large extent incorporated ESG issues into their investment mandates by the end of 2021. Those are quite impressive numbers and really showcase the how the market is maturing around sustainability and ESG investing. But clearly the APAC region is going to play a key role when it comes to transitioning to a more sustainable future, not only when it comes to its importance in the global supply chain, but also due to its influence on global demand and its position in the world economy. At RavenPack, we support the further adoption of ESG principles in investing. We have made it a strategic focus to continuously develop technology that will help asset managers to achieve better and more efficient ESG workflows, providing not only sentiment around companies as they develop their internal ESG programs and communicate with the market, but also to inform investors in a timely manner about any controversy that their portfolio companies might be involved in. This should allow investors to hold companies accountable not only for what they are saying, but also for what they are doing. One of the biggest challenges for sustainable investors today has to do with ESG data. Compared to standard financial data, there are no global regulations governing or requiring reports on such data. This often leads to ESG data typically being deficient when it comes to quantity. I mean, there simply isn't enough data available. Consistency, companies often report different ESG data items, and it's rare to find any ESG data items that is disclosed uniformly across a reasonably large investment universe. And also quality, since methodology is used to derive or compute the reported ESG data may vary across companies. And not surprisingly, this problem multiplies as investors expand their mandates across multiple regions and clearly provides challenges across the APAC region. One way of addressing this problem is to turn to alternative data, which investors have been doing big time in recent years. A trend that looks to continue with expected growth rates of close to 50% per year, partly driven by this new demand from ESG investors. With more than 80% of data available to asset managers coming in an unstructured format, and most of it being text, natural language processing is seen as one of the biggest disruptors in the financial industry in years, fueling the alternative data revolution. And as an expert in natural language processing, and having been in the game for almost 20 years, RavenPack has partnered with several financial institutions in helping them address their needs for turning textual content into a set of structured analytics. In recent years, we have observed a surge in demand, as I mentioned before, for textual analytics to support use cases within ESG investing. Since the beginning, RavenPack has focused on measuring sentiment and so-called actionable events across news and social media content. And today we cover more than 6,800 financial and non-financial event categories across more than 300,000 entities, across companies, people, products, places, organizations, and so on. And soon our entity count will go into the millions, primarily driven by an increased focus on private companies and mapping out supply chains, subsidiary structures. While we started out with news content, we are quickly expanding into other data categories, including earnings call transcripts, filings data, jobs data, and so on. However, the reason for why we started out with news content is because, in contrast to many other alternative data sources, it offers a very rich and flexible data set. Basically, it ticks all the boxes. News is delivered in real time, allowing for nowcasting of traditional financial and economic indicators, or even ESG ratings. But it can also pick up when disaster strikes. You have global coverage through both local and global newswire services across multiple languages. It covers a variety of topics, including business, economic, political, societal, and environmental events across both companies and global macro. And to top it all off, you have deep archives of content available for backtesting and training purposes, allowing users to learn from past events. To address the needs of our sustainable investment clients, RavenPack has worked on expanding and mapping our existing event taxonomy into a specific RavenPack ESG taxonomy, covering events across leadership and governance, business model and innovation, human capital, social capital, and the environment. This taxonomy pivot will make it a lot easier for investors to focus on what they care about from a materiality perspective. In total, we cover almost 370 granular ESG event categories. For instance, we track whenever companies appear in the news linked to greenhouse gas emissions, when they talk about the targets or goals for net zero emissions before some date. We cover anything to do with water contamination, waste dumping or recycling, habitat destruction or reconstruction, donations, cyber attacks and data breaches. We cover facility inspections, workforce diversity, or cases related to gender gap pay or sexual harassment, or any policies related to these issues. We track references to conflicts of interest or whistleblower cases. We track antitrust issues or copyright infringements, or even supply chain disruptions or human rights violations, etc., making it possible to work at any level of granularity as desired, depending on the client use case. Getting a full 360-degree view of a company's sustainability profile is a real challenge. Most company data comes in an unstructured format, which is difficult to consume systematically. Applying NLP and machine learning to unstructured data sources in multiple languages offers a solution that can help address the ESG information challenge. By delivering automated extraction of real-time information, this solution overhauls and optimizes what previously remained a manual and expensive human process. It also opens new and promising avenues when it comes to defining more structured ESG workflows that can increase transparency in the investment process. With that said, I'd like to hand it over to Bei from Monash University, who will be sharing some of her insights looking at the implications for investors when the stocks in their portfolios undergo ESG controversies.
Oh, thank you, Peter. I would like to take this opportunity today to share with you one of my studies about the ESG controversies in Asia Pacific. So let me give you just an idea why I think the ESG news study actually matters. As just Peter pointed out, after the COVID-19 pandemic, the market participants in the Asia Pacific are very confident that the momentum of ESG in the Asia Pacific is growing and perhaps even surpassing other regions' ESG progress. But at the same time, because of the mounting fears about the climate change, the human rights, and the damaging corporate governance failures, the ESG-related risks actually are becoming increasingly important considerations of the institutional investors and the asset managers. Therefore, the impact of the ESG controversies on a company's share price has never been so important. And it brings my interest to study whether the preference towards ESGs of the institutional investors and asset managers actually have impact on the stock price, and how the insights investor can draw from the ESG news. So my study covers the large and mid-cap stocks in 6 major markets in the Asia-Pacific region, i.e. Australia, China, Hong Kong, India, Japan, and Singapore. And my sample covers from 2000 to 2020. And I investigated how the stock price in those markets behave in response to the ESG news event, both in the positive ESG and negative ESG news event. And the information about the ESG news events were obtained from RavenPack. As Peter just pointed out, the RavenPack's news classification system enabled me to isolate the individual events in the ESG-related categories, and also based on the RavenPack sentiment score, I can group the news into positive sentiment, which I call the good ESG news, or the negative sentiment, which I call bad ESG news. So first, let's look at the distribution of the ESG news for each market in this study. Overall, there is more positive ESG news than the negative ESG news in the 6 markets in my study. Among all the markets, Japan has the largest number of the ESG news. And then now let's move on to the different categories of the news for each market. So overall, the labor issues, legal and regulatory issues are the top 3 categories for the bad ESG news, as you can see from the left panel on this slide. While the labor issues, legal and corporate responsibility are the top 3 categories for good ESG news. And you can refer to the red panel of this slide. So in order to understand the stock market returns around the ESG news event, I use event study statistical method. So the method involves finding the abnormal returns attributable to the event, which adjusts the firm stock prices for market returns. Then I calculate the cumulative abnormal returns for the first event date and the next days after the event, and also 5 trading days after each news release. And we can see from this table here that for good ESG news, actually there's little statistically significant reaction, except for a few negative reactions. But for the bad ESG news, we can observe a statistically significant stock price drop in the event and the following days for all the markets here. And now comes the question, so how to explain the asymmetric stock market reactions to good and bad ESG news? So in finance, or in psychology, there is a theory called a salience theory, which suggests that investors overestimate the probability associated with the salient events. The substantial increase in the asset managed in a socially responsible manner actually indicate that the ESG issues are a salient aspect of the information set of the firm. So when the ESG controversy hits here, investors actually give too much weight on the possibility that the event will be repeated and therefore overreact to the news. And also, according to the salience theory, the bad news is more salient than the good news. So the investor should overweight the potential future ESG risk of the stock that is subject to the bad news and discount the price more heavily than the good ESG news. So that's the reason why we can observe the asymmetric stock market reactions to good and bad ESG news here. Since we can only observe the short-term price reaction to bad ESG news, so for the remaining analysis, I will only focus on the ESG controversies. And now let's look at the graphical illustration of the cumulative abnormal returns for a longer time period, which is like 20 days, means like 10 days before the event and 10 days after the event. Overall, it confirms that the significant stock price drop on the event date and on the subsequent following days. We can also observe that the cumulative abnormal returns actually began several days before the news release, which may suggest that there's a possible leakage of the information ahead of the bad ESG news event. The longer time passes after ESG controversy happens, the more time that the investor will have to reassess the ESG risk, and the stock prices may move further. Now let's have a look at the long-run impact of the ESG controversies on each market. In my study, there are 3 types of long-run impact of the firms. First, mean reversion, which we can observe here from Japan. We can see that the long-run post-announcement return revert back gradually after the release of the ESG controversy news. And second, the negative abnormal returns keep the momentum. It means that the stock keep dropping. We can observe that from China here. And third, in Australia, Hong Kong, India, and Singapore, the abnormal return actually didn't revert or drop further either in the 90 days subsequent to the release of the ESG controversies. I would like to give you an idea what the United States stock market react to the ESG controversies as a comparison to what we have seen for the Asia Pacific. So the market reactions of the S&P 500, S&P Mid Cap 400, and S&P Small Cap 600 index constituents follow the pattern what we observed for Japan. It means that we can see a overreaction is hit in the long run, and then we can observe a mean reversion in the long run. And we can also see that the overreaction is more pronounced for smaller stocks, i.e. for the S&P Small Cap 600 index constituents. In a more granular level, let's see what categories of the news are most popular in 2020 for each market. As the RavenPack gives the detailed category of the ESG controversies captured in 2020, we can see that the executive resigned, the legal issues defendant, and layoffs are the top 3 news categories covered in the ESG controversies. So let's ramp up. So the ESG issues has assumed to play a very important role in the Asia Pacific. And we see that the ESG controversies actually lead to a negative market reaction. Let me emphasize here that actually, in my opinion, the ESG controversy news can give the investors an immediate response to this event compared to the ESG readings, which are usually updated semi-annually or annually. And we also observe the trend that the executive resign, the legal issues, and the layoffs are the top 3 popular ESG controversy in 2020, and we may see this trend keep going on in 2021. Thanks, Peter. This is all my study, and I will just hand over back to Peter.
Very, very interesting, Bei, and thank you for your presentation. I think the results that you find are quite intuitive. That companies react more aggressively to, or prices react to controversy more than good ESG news. I would say. I can see that there's a couple of questions that have come in from the audience throughout your presentation here that I'd like to bring up. One question that has come in is why do you think that you don't see the same sort of long-term reversal in China following controversy as you would see, let's say, in the US and Japan? What's the difference there in terms of the markets?
Yeah, thanks for audience to point out. Actually, I'm very shocked or surprised to see this the momentum drop in the China market. But I think deep further. So potentially, the coverage of the Chinese firms by English source media actually endogenous at the beginning. So I'm just thinking that those firms with this bad ESG news were kind of overpriced stocks to start with. So the mispricing corrected itself after the ESG controversies. Or it could be that, the ESG controversies actually change the fundamentals of this firm. Say they cause the cash outflows of this firm, so the negative abnormal returns persistent in the market. That would be, my address to that.
I can also add a little bit. I think you're right. It definitely has something to do with that as well. I wouldn't. I think it's a very good explanation. I think we can probably also broaden it out beyond even ESG or controversy. You'll see that U.S. markets and Japan and so on are I mean, they are faster markets in general when it comes to news reactions. They are more efficient markets generally than many other economies, and therefore you see the market reacting fast and potentially also overreacting. So you'll see the reversal effect probably kicking in earlier, where certain markets like China, you have and also if you look broader, sort of Asia, you see a much slower dissemination of information into stock price, and it may be that helps with a let's call it a more correct pricing, at least over time, over some time period, or it might even have a kicking of reversal at a much later stage.
Yes, you're right, Peter. So actually, I think, yeah, as the markets in the Asia Pacific, as you point out, yeah, they are reacting to this ESG controversies in a slower pace compared to the more efficient markets such as Japan or US. But as a event type of study, if you expand your study period like to beyond the 90 days or further, there are more confounding events happen there. So it's very hard to tell whether this particular ESG controversies caused the market reaction or something. So that's
It's super hard, and even you mentioned this pre-event drift. I mean, I think I mean it's something we're observing too, and you mentioned potential leakage, and that's definitely one possible explanation. But I think one thing which is also interesting is that you also see news tends to cluster. So negative news tends to lead negative news, and positive news tends to lead positive news. So you almost also have this sort of pre-event drift just coming from the fact that there may already have been negative news in the market. So if you go into and try to look for more isolated news, you won't necessarily see that same drift. So my personal opinion is that it may be in certain situations some leakage, but there's definitely also this news clustering effect kicking in. So there was another
I think you're right. Yeah, there was some clustering of the news. Yeah.
There was another question coming in from the audience as well, that asks, I mean, when you look at something like controversy as an ESG investor, probably you want to pull out of the name or something like that. But how do you suggest that investors take advantage of the insights that you have presented? Should they be buying companies that undergo controversy?
Wow. I would say, yes and no. Yes means that, the pattern that we observe here, that we have the market or overreaction and the mean reversion quite clear and significant for Japan here and the US. The investors may be able to profit from this strategy of buying stocks after they observed a controversy hit one particular firm, but clearly not for China here. And also the strategy to buy, I think the strategy to buy firms undergo the controversies also depends on the categories of the ESG controversy news and also the firm size, because the market reactions are different for the different categories of the ESG controversies and also for different firm sizes, which I didn't cover here, but I do find that they have the different reactions in the US market. So please bear in mind that. And more importantly, I think, for actually the investor who can take advantage of this study here is that if they want to reduce their exposures, so it means that these firms has already been in their portfolio and they observe there's some ESG controversy happening in these firms. So they want to reduce this their exposures in these firms. I would suggest they may want to wait, because we see that there's some mean reversion here. So they may just better off wait and choose the subsequent days after the ESG controversy announces.
So basically slowing down their exit strategy, not participating in the overreaction and doing it straight away.
Yeah, because you can see that the most drop in the stock prices on the event date. So you just probably not, execute any trades on that day, and you better off wait until the few days after the announcement.
Thanks again, Bei. Next up, Mixo, looking forward to hearing about your views on the state of ESG in APAC.
Thanks, Peter, and thanks, Bei, for your comments. I guess the way I would frame this discussion is that when you think about something like ESG, which is as groundbreaking and revolutionary as ESG, we tend to think of it from a first principles basis, right? You start from the very basics, and then you try and build out how the world we are in affects ESG, and how ESG in turn affects the world. And from there, we can start to think about how investors should apply and approach ESG. But before I get into any comments, I would flag here that anything I say here is for information purposes only, and should not be taken as investment advice or a recommendation to buy or sell securities. Now, like I mentioned, when you think about where we are in the world, so like a whole system view, if you look at slide 2, this is where we think we are from a global context. And for the purpose of this conversation around ESG, I think there are 3 most important features of the current global environment. Is firstly that the policy setup of the last several decades has broadly failed to A, create sufficient demand, and B, address inequality. And the third thing here is that there is a generational shift underway, and events like COVID have essentially raised the focus, the global focus, on issues around sustainability. If you go to slide 3, based on this, we think that sustainability-related areas are going to be one of the key thematic areas of growth going forward, not only from the perspective of products and services, but also investments. So what that means is basically that we're not just talking about renewable energy and EVs and sustainable food and these thematics driving fundamental growth in different companies, but also that financial products that support this worldview are becoming more and more popular. If you look on slide 4, in a sense, what all this means is that the why ESG question has answers on 3 fronts. Firstly, that some ESG questions have become more pertinent, like climate change and inequality. Secondly, there's a realization more and more that purely financial metrics, or shareholder return, if you will, aren't leading to the most desirable long-term outcomes. And thirdly, with the convergence of data and analytical methods, we are able to do more about these questions about sustainability. So some aspects of ESG, when you think about how basically we implement these philosophies around ESG into financial markets, I would say that some aspects of ESG are basically financially material. Poor governance can directly impact shareholder return. As investors in this region are very well aware, poor governance can also be red flags of potential scandals and reputational risk, leading to volatility in equity prices. Some financially material aspects may also be related to government action, like subsidies for EVs or taxes on tobacco, regulation and spending, like on infrastructure. And another way of thinking about financial materiality is companies that produce goods and services that lead to a more sustainable outcome. This would imply that a good measure of ESG should behave like an equity factor, in some sense, something like a quality, a factor similar to quality, which over time leads to higher risk-adjusted returns from the leaders. Looking at the existing measures of ESG scores as captured by the JP Morgan ESGQ, which I'll mention about in a bit, this is broadly true in Europe, but less so in Asia. And you could say that poor data quality may be partially to blame for that, meaning that there is perhaps some capturable alpha in constructing better scores in itself. Secondly, that ESG is a desirable investment characteristic. What this means is that some aspects of ESG are just about impact, where that consumers, investors, regulators have a good sense that the outcomes that the companies are delivering is leading to a more sustainable world. This may be about either issues that impact financial outcomes, but over a very long periods of time, through customer preference, employee satisfaction, supplier trust, or even investor appetite impacting the cost of capital, or issues that have systemic implications, typically externalities, which are very difficult to capture via financial measures. So in a sense, this is basically like a double materiality, where some aspects are financially material, some are about impact, and the impact issues basically tend to show themselves in financial markets via flows. So when you think about the growth in ESG-related AUM that has happened over the last several years, and we are basically getting critical mass on some of these things, then it is increasingly important for investors to think about how these ESG impact issues are impacting companies' stock prices because of the ESG-related flows. The third issue, or like a transitory issue, is that many things that are on the impact side, say for instance, carbon emissions, where they impact climate, they have an effect on climate change, and they affect sustainability over long periods of time. But in many countries and many regions, they are not yet being factored into regulations to the extent that companies are showing that in their fundamentals. So something like this, over time, as regulations become more transparent and more hard on this, basically these impact issues will migrate into fundamentally, financially material issues. And as a result, this transition can actually be the most relevant in terms of price action when regulation changes something from an impact category to a financially material category. Now, if you look on page 5, this basically shows you some ways we kind of divide how investors should think about these two aspects, or the two primary aspects of ESG, one as a fundamental factor, one as an investment characteristic. Basically, the key thing here is that when you think about ESG as these two separate identities, it leads to different ways of implementation of ESG. So like I said, one, in the initial, as a fundamental factor, you think about ESG in a different way, and when you're thinking of ESG from a flow perspective, you think about ESG in a different way. And the most important thing here is that as a fundamental factor, it's very important for investors to figure out their own sense of materiality across different sectors, different regions. Whereas when you think of ESG driving primarily flows, the ESG score can basically be formalized and standardized, and end up tracking basically the largest or leading index providers or providers of scores on ESG rather than doing the work yourself. So if you look on page 6, that basically shows you our JP Morgan's assessment of materiality across different sectors of different issues, and this can be used to construct these ESGQ scores that I'll mention in a while. If you go to page 7, this is how we translate this ESG discussion into Asia. Basically, it's being driven by changes on regulation, by attitude or behavioral changes among corporates, and changes among investors. And you could throw in that even consumers are affecting change in this space in certain way. I would say that the biggest change is coming from regulators, and you can see that we've seen many countries put forward new carbon emission targets and green targets, if you will. Korea has a Green New Deal, China has a carbon neutrality target, and more countries will go down that way. And many regulators are starting to put together green bond issuance platforms, and Hong Kong is basically leading the way on that. When you think about what the corporates are doing, the biggest area here is really that they are trying to move from a compliant-driven attitude to a more strategic thinking between within the boards, where boards are seriously asking questions about how does our business fit in with a sustainability mindset. And among investors, we come across 3 different types of investors, right? Like the first one is what I call ESG native, where ESG is basically the fundamental driver of how you think about your portfolio, and that's at the core of your stock picking. And then you add on fundamentals, valuations, and macro factors, and so on and so forth. A second one is ESG integration, where you basically create your own ESG scores or use the third-party ESG scores, and then integrate that with your own fundamental stock selection framework, and that becomes your way of expressing this ESG alpha in the market. And the third one is basically where you're trying to catch these companies in that transition, right? Where companies that are seeing regulation change or already have regulations in place which are going to help their fundamentals over long periods of time. And I'll put, solar companies, renewable energy overall, EVs, and so on and so forth in this category, where you're basically trying to capture this growth. And I would say that the latter two are perhaps the more common. I would say the last one is perhaps the most common in terms of ESG investing in Asia at this point. Integration is increasingly coming there, but it's definitely far more prevalent in Europe than it is in APAC. And ESG native investors in Asia are really, you can count them on a handful. Now, if you look at page 8 here, I'll talk a little bit about the JP Morgan ESGQ score. So the way it's constructed is we use slower moving ESG scores like MSCI, which is rebalanced on an annual basis, and we use news flow based scores, like RavenPack has one, but the ones we use here are from RepRisk and Arabesque. And the way it's constructed is that we look at the absolute value of these scores and the pace of change in these scores, and we integrate them together into an ESGQ score, and basically use that to rank all the stocks in every different markets and regions, and we look at the performance of the best ESGQ scores versus the worst. And the thesis here is that it's not just the absolute level of the score that matters for markets, but really also the transition is equally important, where scores are improving or scores are worsening. Now, if you look at the performance of such a factor strategy in Asia, unfortunately, it's not that great. Like I said before, it does much better in Europe, even in the US, than it does in Asia, where if you look on page 9, the green line there in that chart basically shows you the performance of this ESGQ factor. So long top decile, short the bottom decile. And you can see that historically it's been very similar performing to quality, but right now the performance is kind of broken over the last 12 months or so. And this is, we can have a whole another discussion about why quality has underperformed, but that's for another time. But basically, ESG has historically been most similar to quality as a style, but it's increasingly showing that it can be seen as its own factor, rather than a proxy measure for quality or even low vol. So increasingly, it's becoming disconnected with other factors and becoming a factor on its own. So this is definitely an emerging area in Asia, and as data gets better, I think we will start to see more improvement in performance on ESGQ scores as well. The final thing I note here is in terms of crowding, and this obviously ESG has a tendency to become extremely popular and then extremely unpopular, and we've seen several cycles of this. And the way we measure this is by looking at the correlations of this ESGQ strategy performance versus, let's say, a short-term momentum performance. And this is a very good way of measuring crowding. And you can see that historically we've seen several periods of spikes in ESGQ crowding, as in that chart. But right now, that crowding has come off a little bit from what was very elevated in 2Q and 3Q of last year. So let me conclude my comments here, and then we can see how, if you have any further questions from yourself, Peter, or from the audience.
Yeah, I can see that there's a first of all very interesting presentation, Mixo. There was one question coming in here from the audience related to your ESGQ score. You mentioned that, and I'm rephrasing the question a little bit here, but you mentioned that there's better performance in Europe and the US, and Asia was lagging a bit, and you were pointing towards potential quality issues. But how should you look at this factor? I mean, is it an alpha factor, as you know, or could it also be considered more of a risk factor, perhaps in Asia as compared to in other regions?
Yeah, so there isn't a very good answer to this. I would say that when you look at the performance characteristics of this factor, it has historically been very similar to what you get from quality and low vol, which means that on an absolute basis, it doesn't outperform a lot, but when you look at it from a risk-adjusted basis, it does really well. So a lot of the benefit of using ESGQ, even in Asia, this is true, where the benefit of using ESGQ is really in terms of reducing your risk, reducing the volatility of your portfolio. And this is something that we have tested, and I think Bei referred to as well, where the downside risk mitigation is really where ESG does the best. And we've seen historically in terms of drawdowns or portfolio volatility, that's where ESG looks, the ESGQ, even the ESGQ scores look really well in terms of their performance.
I guess that this question sort of goes into this whole discussion around whether ESG is really about alpha, or if it's more about risk mitigation or sort of this downside protection. I mean, we have done some internal research also looking at, you know, MSCI ratings, and it's clear to see that you are getting some protection on the downside, right? Where it's generally, even though there is an alpha component there in distinguishing between, you know, good ESG versus bad ESG companies, that most of the sort of benefit is coming on the downside protection. Right. But I think it's an interesting question, and it obviously opens up for this whole discussion around if it's really just a constraint on your portfolio, or if it's really something that adds value. But we can potentially get back to that as we open up our discussion broadly across the three of us. Thank you, Mixo, again, for a very interesting presentation. So, Mixo, as part of your presentation, you made references to why there might be this big explosion in ESG interest and sustainable investing across the APAC region. But I mean, as you also pointed out, it's been around for a long time, you know, perhaps more in social responsible investing and all of these sort of things as well. But why is it happening now? You suggested COVID as being one angle, and perhaps the millennials, the generation shift, another one. Are there other things that sort of drives that change today?
So if you look at the pace of growth in ESG assets, actually the step change in growth rate, I think that you can mostly put that down to COVID. But other than that, what has really happened here is that we're just getting into a size that's become reasonably sized. So it's become systemically important, basically. So the growth has been happening for years, and now we're just coming to terms with the fact that it's a reasonable size of the AUM in the APAC region, and investors are actually incrementally more and more investors are starting to care about it. And now we have a size of investors that is significantly market moving. So that, I think, is perhaps the largest thing. The second thing that's also happened is with the availability of data and more faster analytical methods, and I'll put an AI in here. This is something that we've seen across various areas where technology has enabled investors to do something that they've always wanted to do, but they haven't always been able to do. And tracking ESG, like in terms of controversies or in terms of the minute data which goes into building the ESG profile of a company, that hasn't always been possible previously. So now that we are able to do that with RavenPack data and the variety of other data providers on the scene, that has also been an enabler of investor interest in this area.
And I suspect also, I mean, if you look at the venture cap space, I mean, there's a huge interest there as well from an investment side on investing into companies that address sustainability or climate change has a story there. So as an academic, Bei, you are also looking into doing research around ESG and of course looking at various data sets out there that can help you in sort of modeling out the effects. What is your observation here? What's your experience when it comes to identifying interesting data sets for research from a sustainability perspective, and what does the coverage look like across Asia?
Yes, Peter, I think definitely the ESG data has some challenges at the moment, especially for the Asian Pacific regions. So I just share you with some experience that I have done for my research. So I want to have a comprehensive ESG ratings for the Asia Pacific firms, and it come to my attention that it's very difficult to have a comprehensive ESG rating coverage for Asia Pacific firms. For the major ESG rating agencies, most of them only covers the firms that included in the major indices in the Asia Pacific. So if we really want to get the whole set of the firms in the Asia Pacific, I need to go to the local rating agencies, which I'm not quite sure about, the quality and the trustworthiness of these rating agencies. And again, I do observe that, for each different rating agencies, they cover the different metrics of the ESG ratings. So you will get like thousands of fields put out from the ESG rating agencies, and you can it's not very easy to just standardize the ESG ratings and get a clear understanding what actually these ratings reflect. Yeah, Peter, that's one of my observations. Yeah.
Yeah. So you basically the ratings are surely a lot more black box, and
and also like on top of that, you can see a huge discrepancies among the different rating agencies on one particular firm.
I think we could probably discuss this particular point for forever. I think it's interesting, and there will surely be other opportunities to discuss sustainability and greenwashing and data and regulation and so on in the future. But before we finish, I'd like to say again, I'd like to thank you all for joining. I hope that you have found it useful and entertaining. And note that the session has been recorded, and will be made available after the event. Also, I'd like to thank our guest speakers, Bei and Mixo, for their valuable insights. And if you haven't done it already, you can still download the research papers from RavenPack and from Monash University. They did a very interesting paper. You should take a look at it. And they're all available on the right-hand side of the screen. With that, thank you all, and I hope we see you again when we present our next webinar.